You see the perfect breakout setup, a price rally that seems ready to skyrocket. You enter the trade, and for a moment, it feels like you've hit gold. But then, out of nowhere, the price reverses, leaving you in a loss. Sound familiar? Well, today, I'm going to share a strategy that not only helps you avoid these dreaded fakeouts, but actually lets you profit from them. To avoid fakeouts, we need to understand liquidity and fair value gaps. Liquidity is the fuel that drives the market. It's where the big players like hedge funds make their moves. Imagine you're in a long trade. Where would you place your stop loss? Most traders set it just below the recent low. Guess what? So do most other traders, making that level a huge liquidity zone. This is where the trap is set. Big institutions know exactly where retail traders place their stops. So, the market dips, triggers those stop losses, and sweeps up all that liquidity before reversing in the opposite direction. This is why many trades fail, because we're caught in the liquidity traps set by big players. Now, let's talk about fair value gaps. This happens when price makes a big move, leaving a gap that the market wants to revisit. You can find these gaps on higher time frames, like the 1 hour or daily chart. They often mark areas where the price will likely return before making the next big move. Spotting these gaps can help you predict where the market is headed. Alright, let's walk through the strategy. First, look for equal highs or lows on the chart. These are our liquidity zones. Next, identify any fair value gaps on higher time frames near these zones. Once we see a sweep of liquidity, where price breaks through a support or resistance level and then reverses, watch for it to test the fair value gap. Here's how a typical trade setup might look. Price hits a major low, triggering stop losses and gathering liquidity. It reverses and moves up toward the fair value gap. Then, as it enters the gap, you have your entry point. This setup lets you capitalize on moves in the market that big players are also watching. Let's look at an example. Imagine you have a chart with equal highs and lows. The price dips, taking out the liquidity at the lows, then moves up and creates a fair value gap below. As the price retraces into that gap, it becomes a prime entry point for a long position. From there, we wait for price to make a strong move, often targeting new highs, where it'll create fresh liquidity. Here's why this strategy works. The best moves happen after liquidity is swept. Think about it. If you want the price to go higher, it often needs to drop first. And if you want it to fall, it usually spikes up first. This isn't just theory, it's how the market actually works. Price is always hunting for liquidity and imbalances. Once you start viewing the market in terms of liquidity and fair value gaps, it will completely transform the way you trade. And it's not just about avoiding fakeouts, it's about consistently identifying high probability setups where you can profit alongside the big players. Don't forget to subscribe my channel. The link is in the description. Hit that subscribe button, give this video a thumbs up, and let's get you trading smarter today.